Foreign exchange risk and currency funding mismatches. Understanding risks and effective hedging strategies. Agenda overview. Understanding foreign exchange risk. Currency funding mismatch. Hedging strategies for foreign exchange risk. Implementation of hedging strategies. Definition of foreign exchange risk. Understanding foreign exchange risk. Foreign exchange risk is the financial risk that arises from fluctuations in currency exchange rates, impacting businesses globally. Impact on financial performance. Fluctuations in exchange rates can significantly affect cash flows, profit margins, and the overall financial health of a business. Risk management strategies. Understanding foreign exchange risk is crucial for developing effective risk management strategies to mitigate potential financial losses. Types of foreign exchange risk. Transaction risk. Transaction risk arises from the time delay between entering a transaction and its settlement affecting cash flow. Translation risk. Translation risk occurs when financial statements are converted from foreign currencies, impacting reported earnings and assets. Economic risk. Economic risk is related to the long-term impact of currency fluctuations on a company's market value and competitiveness. Impact on businesses and investments. Foreign exchange risk. Foreign exchange risk can significantly impact businesses by leading to increased operational costs and reduced profit margins. Impact on profits. Businesses must understand how currency fluctuations can diminish investment returns and overall profitability. Strategic business decisions. Recognizing foreign exchange risks is crucial for making informed strategic decisions in the global market. Currency funding mismatch. Understanding currency mismatch. Currency funding mismatch occurs when there is a discrepancy between borrowed currency and operational currency. Causes of mismatches. Common causes of currency funding mismatches include business expansion and varying borrowing strategies that do not align with revenue currencies. Impact of market fluctuations. Market fluctuations can exacerbate currency funding mismatches and impact a company's financial stability. Examples of currency funding mismatches: US company borrowing in euros. A US-based company borrowing in euros while primarily earning in dollars creates a currency mismatch that can lead to financial risks. Exchange rate risks. The mismatch in currencies exposes companies to significant exchange rate risks, which can affect profitability and financial stability. Consequences of currency funding mismatches. Earnings volatility. Funding mismatches can lead to increased volatility in earnings, making it difficult for stakeholders to predict financial performance. Cash flow difficulties. Companies may experience cash flow difficulties due to mismatched funding, affecting their operational capabilities and stability. Higher borrowing costs. Funding mismatches can lead to higher borrowing costs, decreasing profitability and increasing financial strain on the business. Impact on valuation. Ultimately, these factors can negatively impact a company's valuation, influencing investor decisions and market perception. Hedging strategies for foreign exchange risk. Forward contracts. Hedging against currency fluctuations. Forward contracts help businesses mitigate risks associated with unpredictable currency exchange rates, ensuring financial stability. Stabilizing cash flows. By locking in exchange rates, forward contracts assist companies in stabilizing their cash flows over time. Predicting costs. Forward contracts enable businesses to accurately predict future costs related to currency transactions, aiding in budgeting. Futures contracts. Standardized agreements. Futures contracts are standardized agreements facilitating reliable transactions between parties for currency exchange. Predetermined rates. These contracts allow parties to agree on a predetermined exchange rate, protecting against market fluctuations. Liquidity and transparency. Futures contracts provide liquidity and transparency, enabling easier trading on exchanges and better price discovery. Options and currency swaps. Understanding options. Options give the right to exchange currencies at a predetermined rate, providing flexibility in currency management. Currency swaps explained. Currency swaps allow companies to exchange principal and interest in different currencies, optimizing debt management strategies. Debt management strategies. Utilizing options and currency swaps can significantly improve financial strategies and manage currency risks effectively. Implementation of hedging strategies. Steps to identify exposure. Analyzing cash flows. Understanding cash flows is vital in identifying exposure and assessing potential financial impacts. Assessing currency risks. Evaluating currency risks helps in understanding how exchange rates fluctuations can affect financial performance. Impacts on financial performance. Identifying potential impacts on financial performance informs the development of effective hedging strategies. Selecting appropriate hedging instruments. Understanding risk profiles. Company-specific risk profile is crucial in determining the appropriate hedging instruments. Different risks require tailored solutions. Market conditions impact. Evaluating market conditions is essential for selecting hedging instruments. Market volatility can greatly influence the effectiveness of hedging strategies. Financial goals alignment. Aligning hedging instruments with financial goals ensures that the chosen strategies support the company's overall objectives and minimize risks effectively. Monitoring and adjusting hedges. Importance of monitoring. Continuous monitoring of hedging strategies is crucial to adapt to dynamic market conditions effectively. Adapting to changes. Adjustments to hedging strategies should be made based on performance metrics and the evolving needs of the business. Conclusion. Importance of hedging. Hedging foreign exchange risk is essential for businesses to protect against currency funding mismatches and ensure financial stability. Understanding risks. Understanding the various risks associated with foreign exchange can help businesses make informed decisions and mitigate potential losses. Hedging strategies. Exploring different hedging strategies allows companies to effectively manage their financial exposure and reduce volatility in international markets. Best practices. Implementing best practices in currency risk management helps companies to stabilize their finances and improve profitability in global operations. Thank you.